Hello, I'm Libby Ashby from CityWire. I'm here with Haig Bathgate, CIO of Tcam. Today we're going to be talking about the current state of play in global financial markets. Despite May's nightmare election in June, the UK market has been somewhat resilient and global expansion is chugging along and volatility has been somewhat muted. However, geopolitical issues are still bubbling. North Korea is particularly worrying with its aggressive development of nuclear weapons, and Trump's promise to react with fire and fury. How are you feeling about the global and UK economy at the moment?
It's quite difficult to adjust portfolios to this because a lot of this is short-term noise, and ultimately some of these things may materialise or not. The tensions with North Korea and the US, for example, anybody knows how that could go, and it changes on a daily basis. I suppose of slightly more concern potentially is the position in the UK market and the UK political environment. However, we think actually the lessening of May's grasp of power at the top is actually quite good for the Brexit negotiations.
What about central bank liquidity? People are talking about that at the moment. Are you worried, and how the impact of them trying to shrink their balance sheets?
However, we've seen subdued inflation, subdued wage growth, and that means interest rates haven't risen to the levels that we've seen them historically. So we just don't know how this is all going to pan out, but we do know that central banks are going to tread very carefully. But we think that the path of interest rate increases will be subdued across the globe, basically.
And what about China? I'm hearing mixed report. I mean, lots of people are worrying about its high debt levels, but others are quite positive about its growth forecasts. What are you feeling?
I think the key factor and the reason that we're not so concerned about China at the moment is just the fact that a lot of that debt is internalised. So a lot of people are looking at history and they're saying that emerging markets like China have got into difficulty. It's when they've had large external debt balances denominated in dollars. And of course, when your currency starts to depreciate, the real value of those obligations increase. However, in China, the authorities are showing that they've got quite a good control on things. However, the debt levels are worrying and will manifest themselves at some point, but we don't think that's a near-term feature.
You mentioned emerging markets there. Are you sort of looking to increase your exposure there at the moment or not?
At the moment, we've had a very good run, so we're actually not pessimistic about the outlook for emerging markets, but it's a question of valuation. Asian emerging markets are very much dominated by what's going on in China, so we're not overly concerned about China. However, we've seen such a run now in emerging markets, it's hard to see much value there.
And do you think that's the same for Europe? A lot of people are talking about whether it's a crowded trade at the moment.
I think everybody's sort of changed their view on Europe, and everybody's pretty positive. There's always a lag, as we know, so people will talk about things, but it takes them a long time to actually move those positions. So it takes time for the weight of money to actually move into Europe. But we've been quite positive in Europe for some time now. Although the areas that we're positive are, we're quite specific about. It's areas like financials, and by implication, UK financials will benefit from that as well.
And can corporate earnings continue to rise, or was the last round just down to sterling weakness?
If you look at the composition of the UK markets, banks we think are going to fare quite well. Obviously, we've seen Royal Bank of Scotland recently start to perform quite well. We're also at the end of the sort of bank bashing period. We think PPI claims are coming to an end, and typically it's 10 years after the last crisis is the best time to start investing in the asset that's blown up, and that was the banking sector.
What is the biggest concern that's keeping you up at night at the moment in the current economy?
Well, I think we are strong believers that we're in the final stage of this bull market. To us, it feels very like 1998. Again, in terms of some of the valuation of tech companies which are going through the roof. Companies like Amazon are, the valuations that are now attached to those types of companies are eye-watering. We know from the last tech bubble that those can go from very high to kind of ludicrous levels before they correct. But we certainly think that part of the market is looking very, very stretched, and that's the area that worries us most.
So what is the key message you're sending out to clients at the moment?
Well, I think it's one of those. It's late cycle, so we don't want to play the hero too early. We don't want to hold too much cash, because again, we know if reminiscent of the late 90s, if you become too defensive too quickly, you can give a lot of performance on the upside. However, the great thing about the period that we're in at the moment is, as investor complacency increases, and can measure that through the implied volatility index, it becomes cheaper and cheaper to insure portfolios.
Haig, thanks very much for joining us.
Thank you.